Let's start with that overhang, I guess. One of the reasons that the first quarter results look good is that they got to pay a breakup fee from Paramount. So factor that in. But I think that is the story. There's just this overhang of what life looked like after walking away from the Warner Brothers Discovery deal.
Well, walking away from the deal has, in the short term, up until earnings, been really good for the stock, right? The stock was up quite a bit over the last few weeks. Investors did not like the Warner Brothers deal. They were worried about how much Netflix was paying. They were worried about what it would mean for the company. But it also fed sort of, I think, expectations that the forecast for this year would be revised in a positive way. And instead, even though Netflix had a better first quarter than they expected in terms of subscriber growth and revenue, they maintained the estimates and they warned that actually profit and margin would be down a little bit in the second quarter because of increased spending on programming.
So maybe the market got ahead of itself. Where did they get impacted by Reed Hastings? How much is that a concern that this looming large figure co-founder is going to be stepping and looking more at philanthropy?
Yeah, hard to quantify, of course, because it's not like the investors are saying, well, I sold for this reason and I sold for that reason. But look, it has to be a factor. On the one hand, Reed Hastings has been telegraphing his departure for a long time. In 2020, he names Ted Sarandos as co-CEO. In 2023, he steps down as CEO and becomes executive chairman. Then he becomes just chairman. He's been signaling that he's going to withdraw from this business because he feels like he's done his job. At the same time, this is the guy who led the company for most of its existence, did a tremendous job. And so his departure is going to worry people.
Just to point out that Reed Hastings is also a board member of Bloomberg Inc. and Bloomberg LP, the parent company of Bloomberg Media, the parent company of this network. Lucas, there's a lot of choice right now. I watch Netflix. I'm watching The Night Agent. I think it's very good. You might watch HBO Max. You might be Disney Plus or Hulu. Did we learn anything about Netflix's content slate strategy? You know, they've been pushing into live, pushing into games. It's not really clear to me, like, what happens next on that front.
They're staying the course for the time being, at least. They're sort of reiterating we're confident in what we're doing. Yes, they're moving into some new areas. Video, podcasting, live programming, and gaming were the three that they signaled both in their letter to shareholders and in the call. I don't think those have immediate or dramatic impacts on the business. Podcasting is not registering in a big way yet. Live is probably the most significant, but they are being very selective about what live programming that they do. And video gaming, they would acknowledge, has been a miss so far, but they feel like they're starting to develop a more comprehensive strategy. For the most part, you look at the $20 billion, $19 billion they're going to spend this year, and it's on the same kind of scripted programming they've done for a long time now.
Lucas Shaw, as always, brilliant to have you, leader of Screen Time. We appreciate it. Let's get more on Netflix with Alicia Reese, Wedbush Securities Senior Vice President of Equity Research. You've actually got an outperform rating on the stock, $118, 12-month price target, actually raised a little bit from 115. So the confidence, Alicia, talk to us about where the confidence comes from.
Yeah, I think the ads strategy is what is being underappreciated here. Domestically, I think they had to put a lot into content in the second quarter to offset or, just give the user reason to for resilience on the subscriber. The premium tiers, but those who are not convinced could easily go to the ad tier. And we've seen with our survey work over the years, a lot of resilience around that since they introduced the ad tier. I think there's a lot of reason for people to stay when they when they post all of that content. And to Lucas's point, podcasting hasn't been a huge mark so far. But, Netflix did point out that a lot of their users are coming on during the day when they wouldn't normally come on. And so that is incremental engagement. I think it's useful to have as much incremental engagement as they possibly can as they raise price. I do think it will be incremental here with the price increases domestically, perhaps not in Europe. There is some legal pushback right now on the price increases in a few countries and could potentially be in the continent. I think, the ad tier is really, the piece that is underappreciated here. Right. There's so much opportunity for them to expand. And as they increase price, some people and quite a few people tend to get pushed over to the ad tier. And with Netflix's low ad load and higher CPMs and potentially growing CPMs, they can benefit pretty handsomely in the back half of the year.
Alicia, can you go sort of geographically for us a little bit? Because perhaps we're underwhelmed in terms of first quarter and pushing forward. First quarter, US, Canada was actually a slightly slower growth than anticipated. But Asia doing well, Europe doing well, Latin America doing well. Is there still the growth areas?
Yeah, I think it's really important to note that, because of the geographic diversity, their results are, pretty steady overall. The World Baseball Classic was a huge hit in Japan, but it didn't seem like there was a lot of churn soon after. There was a lot of content that people in the region found really favorable, and so they kept on the service.
Right.
And Netflix noted their ad tier being, having a little bit more heft in the region because of that increased subscriber growth. So that's something that we had not factored in. The average revenue per member is quite low in APAC, and I think advertising in Japan and elsewhere in the region could really boost results. UCAN wasn't as strong as we had expected it to be in the first quarter, but there was a range, and it was really within the range. Our survey work, just suggested that it was pretty standard, par for the course, nothing, hugely a miss or a beat. But you do have some decent trends in Europe, absent the price increases as well. So I think overall, regionally, they're quite healthy, and they'll continue to be. But there was nothing domestically that helped them hit it out of the park this quarter.
There's a line in the Bloomberg story, Alicia. Wall Street is looking for signs Netflix can keep subscribers engaged. And Netflix has not disclosed subscribers since the first quarter of 2025. It focuses on engagement, time spent. And so you've gone over a number of interesting telltale signs of how you assess the health of the company. Going forward, what is the metric that proves definitively that Netflix is taking time and eyeballs in a world where you have a lot of choice and it's not just about streaming platforms in that battle?
Well, it doesn't matter whether they're on the premium tier or the ad tier, so long as, Netflix is extracting increasing revenue off of these users, and engagement is clearly an important sign. But so you're looking at a combination of revenue, whether they're getting the highest subscription price or whether they're on the ad tier and engaging significantly with the content and providing a lot more value to advertisers and therefore revenue to Netflix. And if they're able to do that at a reasonable cost of content, the profitability will continue to climb and free cash flow will continue to climb. And that's what we've been seeing. And so for us, that's a huge positive. In the second quarter, surely there's going to be a lot of content amortization, a lot more content on the service. But in the back half, that's going to even out, and they'll be able to hit those full year targets and probably exceed them.